Folks, there's no question you've probably heard over the last multiple years that cash is trash. I've always thought of cash as an option on the future. But again, I think it's worth a conversation. What is the one and only Anna REI mom Kelly doing with her cash? Does she just treat it like trash, or what is she doing today differently? Anna, how you doing?
I'm doing great. I love this conversation because, cash is king or cash is trash, depending on what you're looking at, depending on where the economy is, and depending on where your other options are, right? And so I really, really like Ray Dalio. I follow him a lot. He's a very wise investor, not in
Sure.
the real estate realm per se, but he's a hedge fund manager. I think the fifth largest financially important company in the world,
Mhm.
and the largest hedge fund created the most wealth for his investors. Really smart guy. And during the height of inflation, I mean, he came out and he said, cash is trash, and everybody was quoting him, right? But then he came back and said, wait, things are changing really rapidly. And now cash isn't trash. Now you want to
Mhm.
hold it. And so things change very quickly, especially, as we've seen over the last year as the government is trying to get a hold of, inflation and raising interest rates. Here's the thing. If you're holding cash right now, sometimes that can be a wise thing, and sometimes that can be not so wise of a thing. And it just depends on where you think inflation is going, where you see other opportunity, and what the returns that you can make are if you deploy that cash versus keeping it, right? So I will say this, in the past, the last 10 years or so, like we referenced in, the last video, we've been in a really low interest rate environment. And so I would leverage as much as I could wisely with just a little bit of cash reserves, the amount that makes the lenders happy to keep letting me borrow money, because I was basically borrowing below true inflation, what I believe is true inflation, and making huge returns with the positive leverage created by borrowing at, literally between 2.3 and 4% for most of my money for a very long time. We're in a different market now where, because of the Fed's battle against inflation, they've raised interest rates so much that you can now park your money in a money market account, in a CD, and make over 5%. I was seeing we're almost at 7% in certain vehicles. So if I can place my cash in something that's fairly liquid, and make 5%, 6%, 7% when interest rates are 7-ish, and I can't find other deals that are allowing me to make a lot more than that by locking up my money, then it might be wiser to be a saver right now and, saving money, because right now savers are being rewarded, investors are not being rewarded, kind of disincentivized by interest rates, when we haven't seen that in a really long time. So I think it really depends. I think it really depends. I'm sitting on more cash today than I've ever sat on in my entire life. And I sold a lot of properties. I got liquid, and I'm being really patient. And so until I find a place to deploy that cash where I'm making returns that on a risk adjusted basis I'm really happy with, I have a lot of my cash and financial instruments that are paying me no less than 4 and up to 5.05% on my money while the cash is sitting there liquid.
It's funny when I look at the 22 years or so I've been investing. I would say 15 years of that, uh, cash, I almost repelled cash, right? I had an emergency account for the family, an emergency account for the real estate that never got touched unless an emergency. But
Yes,
once I got to some number, it was deployed,
me
right?
too.
And it's really weird. You retire. It's been now 5+ years for me. We start flipping the first 2 or 3 years. That goes really well because that's just where the market was. Now I'm sitting here going, I see all this great opportunity coming, specifically around small commercial, right? Fives to 40s, but we're
Mhm.
not there yet. I want to,
Right.
I'm not in a rush, right? To your point, being patient. I am looking to deploy cash maybe in an ADU, build an ADU just to see if it works. I'm back on that. Um,
Yes.
but yeah, if you can get 5% on your money, I don't know, you probably need 9 or 10% to really deploy it, at least for me, given where we
Yes.
are. And there's a lot of people that were buying real estate deals with a 3.5 cap, right? Kind of, A class properties.
Yes.
That doesn't feel good today, I don't think.
I agree with you. In fact, I just saw something today, an A-class property. It's a few years old, and they're trying to sell it at, they would make after all their expenses 5.74% on the money. And they're asking in a Facebook group, should I buy this property? And I'm thinking, okay, if I can make 5.25 in
Right.
a high yield savings account, which I can right now, or a
Mhm.
5%, even locking it up for a year in a CD, why would I take on the headache and the risk heading into a recession that I can't fill a property, that it's vacant at all, during that hold, that anything goes wrong with maintenance, and only be rewarded by about half a percent in
Yeah.
return for holding that property? I'm probably not going to do it. So to your point, I'm really looking at things that I can make minimum 10% return on my
Yeah.
money. Otherwise, I'd rather have that optionality. So if you're
Exactly.
putting it in like a high yield savings account or a money market account, it's liquid. So if I find a property tomorrow that's going to pay me, 10, 15, 20% plus, I can easily take that money out and redeploy it. So I wouldn't go lock up all your cash in, long-term bonds or long-term CDs that you can't get out of. But what you have to understand is that when interest rates go up, the risk-free rate of return goes up. And so you need to be paid a premium for taking on risk on anything else that you buy. So if I expected 10% return on my money 2 years ago when interest rates are low, today, to take on the risk of the economy and recession and people, not paying, I want to make more than 10% of my money. I want to make 20% of my money to compensate me for the risks that I'm taking. And so sometimes it's smart to just stay patient, stay a little more liquid, make a return on your money, 5% easily, while you're waiting on that next investment property. And don't try to rush to deploy it just to deploy it. And it's so counter to everything that I have done over the last really 15 years or so.
Yeah.
But I learned another valuable lesson. So one is optionality, right? Two is the risk-free rate of return versus the risk premium. Three is patience, but four is also preservation and security. So I learned a big lesson during the pandemic, right? Everything had gone really, really well for most of my, investing post 2009. But during the pandemic, we had an eviction moratorium, and they still exist in parts of the country where I'm invested in, where judges are still not making people move. And so the only reason we got through the pandemic with about 1,000 units at the time was because we had a lot of liquidity. We had sold some things. And so that liquidity helps you to weather, another economic disaster, a deep recession, your own job loss. And so if you don't have cash and you're trying to quickly deploy everything, you really are putting yourself at risk of having banks call your loans, not being able to, meet your monthly nut that you have to crack, or a furnace going out with a tenant, you can't afford to replace it. So it's really important in this kind of economically volatile market that you have some cash, extra cash, for safety, and sometimes being able to sleep at night and having that safety net is much more important than deploying it to make a little bit better return than what you can get by holding cash in a savings account.
Yeah, and that's kind of exactly where I'm at. This is not about making little incremental deltas, right? We're in a very interesting time. For you and I, this is our first, at least, investing career where rates are in a rising environment. And yeah, if you can go get 5% easy, go take the layup, right? But I think it's
Right.
really important for people to hear you and I are still shopping every day. We're still running
Yes.
deal analysis. We will strike, if we get a 10, 11, 12, or it's right in our sweet spot.
Yeah.
I think a lot of people go, I'm going to go get 5% and I'll be back in a year. You're going to miss at minimum all that education and networking, but you're going to probably miss out on a deal or two that would have given you that 12, 13, 14%, because sometimes people just have to sell and you need cash.
Absolutely. Absolutely. Yeah. And I made a creative offer last week that I'm waiting to hear back on. That'll require me to deploy a whole lot of the cash that I have, but the returns are minimum 15% annualized. And that doesn't include, equity growth, mortgage pay down, et cetera. So, if I can find something today that's a solid property that I want to hold for the long term, that I still think can go up in value, where it's not peaked and going to come down, and where I can make that kind of return, then I'll gladly give up a bunch of cash for those properties. But it's got to be a really
Sure.
amazing deal to make me, part with cash for anything less than, in my book right now, I'm probably at least day one, 12%. Otherwise, I'm holding it.
There you go. And I think over the next couple of years, there will certainly be opportunities to deploy that cash. And you and I were, I have no affiliation with a big stack of cash. I frankly want my cash working. It's just 5% easy is better than 6% hard. So I'm
Right.
taking the
And
5%
one
easy.
last thing, I know we're going long on this one, but just something to keep in mind too. If you look historically at institutional money, big money, right? Insurance companies, banks, etc. They're parking, the reason they would park their money in things like multifamily, class A multifamily and triple B bonds, making them about 3.5 to 4% on their money,
Wow.
is because that's what they expected to be fairly risk-free, but a little bit better than what they could get in treasuries. And so we think of 9% as being like, man, that's nothing, right? Because we're used to 20% returns every year on most properties that we've bought. At least I have over the last decade or so. So at first I was seeing sevens and eights, and I'm like, man, that's nothing. But if you look at long term, what the big boys do, they've been happy with 3.5, 4, or 5%, just a little bit more risk for a little better return than a treasury. And so always look at the treasury as kind of your benchmark for like, this is the safe return. And if I can beat that by a little bit, and be happy with the property long term and have more than just the cash flow, but also, mortgage pay down, opportunity for equity to go up, then don't feel like that's a horrible return, right? We don't want base hits right now. We're not going to get home runs probably for another year or so. But if you can get to second or third on a property, deploy your cash. And if you can't, be patient and don't compare today's return to necessarily what you had last year, because it's not going to be the same and probably won't be for the next couple of years.
Yeah, and again, don't stop doing the work. You've spent the time doing it. I know it's hard. It's
Yeah.
an interesting environment. You're not seeing what you hope to see. Just keep going. We are in a very interesting market. It's hard for Anna and I as well, but
Yeah.
we're not stopping. So Anna, where can people find you?
Great. You can find me here every week on your show. You can find me at social media at Anna Kelly REI Mom. And my website for coaching and consulting is reimom.com.
Thank you so much.